Welcome to Not Just Money with your hosts, Doretta and Li. This isn't your typical podcast about finances. It's a podcast about all the money conversations we aren't having, sometimes not even with ourselves. Join us on this journey of hard truths, lived experience, and the wisdom that comes from both. Because money is never just about money.
Hey Lee, a back to basics conversation today.
Ooh, I love these episodes. For those who know, it's always good to have a refresher. And for those who are starting their money journey, basics are essential. Don't get me wrong, I love when our chats go existential and talk about the emotional intensity behind money. But if we really want to be in control of our financial destinies, we also need to talk about the numbers, the math, the semantics, because that's where change and improvement happen. Okay, today, let's dive in. TFSA versus RRSPs. What they are, what they do, what to prioritize when. We get asked this a lot. And to be fair, we touched on it maybe a little bit in one of our earlier basics conversations, but not in enough detail.
Yeah, I think in some of our early episodes, we probably tried to do a little bit too much at once. We had so many ideas, so much to share, but let's correct it now, deep dive on what they are, what they do, and what's the difference.
Okay, but to be clear right off the top, we are absolutely not going to be giving any investment advice. So if that's what you're here looking for, you won't find it in this episode. What we are going to do is focus on the who's, what's, where's, and why's. RRSPs and TFSAs are registered savings and investing accounts that can help you reduce your taxes. We are not going to talk about what to put in them. For that, you really need to do your research and consult a professional advisor.
Absolutely. We're going to be talking about RSPs and TFSAs as investment vehicles, things that hold investments, not what specific investments you should hold in them. Okay. Super high level, registered retirement savings plans, RRSPs, and tax-free savings accounts, TFSAs, are basically savings or more accurately, investment accounts.
I've always wondered about their names. I think investment is way more accurate than saving. And honestly, if they just named it that, I wouldn't hear these stories where people just put money into these accounts or just open them and say, well, I did it, check mark, not realizing that you actually have to do something in those accounts. More on that later.
Yeah, I agree. Anyway, so the thing is, they're registered accounts, and that means they're registered with the federal government, and they allow you to save and invest money protected from income tax. But the way they do it is different. RRSPs give you a tax deduction today when you make your contribution, and the money you save and invest accumulates tax-free, but you pay tax on it when you withdraw it.
People have the idea that RRSPs are tax free, but they aren't. They're what we call tax deferred. And always remember the government wants their money. So there's no such thing as free money. And the idea is that when you are retired, you will most likely be in a lower income tax bracket. So, in addition to a tax deduction on contribution, so that's money that you're going to get back, probably, when you do your tax returns, and then the gains accumulating tax free, you pay less tax on withdrawal.
Exactly. Now, TFSAs are different. There's no deduction when you put your money in, but your savings and investments earn tax-free. And here's the important thing to remember, you do not pay any tax when you withdraw the money. So, no upfront deduction, but investment growth and withdrawals tax-free. So that's one of the key differences to remember. RRSPs, tax-free dollars going in, taxable coming out. TFSAs, after-tax dollars going in, tax-free coming out. People talk about them both as tax shelters, but they're different. TFSAs are tax shelter. RRSPs, as Lee was just saying, are tax deferral shelter.
There are some other important differences, and we'll get to those because ultimately it'll help you decide which one you should use when, or sometimes first. But two important things they have in common. One, they can both hold cash, GICs, stocks, bonds, and investment funds. And two, everything earned inside those registered accounts grows tax free.
So let's start with RRSPs. First, a little historical background.
Ooh, bring on the rabbit holes.
It's interesting, really. Okay,
I
so
believe
first,
you, I do.
yeah, RSPs have been around for a really, really long time, since 1957, which is almost a decade before the Canada Pension Plan was created.
Wow, I didn't know that.
They were the brainchild of the Saint Laurent Liberal government, and the goal was fairness. So back then, if you were lucky enough to work for an employer with workplace pensions, your pension contributions were tax deductible. In fact, they'd been tax deductible since 1919. But if you were self employed or your employer didn't offer a pension plan, there were no tax breaks for retirement savings. And that's why RRSPs were created to give all working people the same tax breaks for retirement savings. So there have been a lot of changes since then, but that basic bargain is still there. Contributions deductible, investments compound tax free, income tax payable when you take the money out.
So basically, RRSPs were created primarily for the self employed and workers without employer sponsored pension plans.
Yeah, exactly. And remember, this was before the Canada Pension Plan existed. Before RRSPs, people funded their retirement through personal savings, family resources, employer pensions if they were lucky enough to have them, and old age security, which has also been around a really long time, actually, in some form since 1927. Okay, there have been a lot of changes since then, especially to RRSP limits in 1990, but I'm not going to go into those because I wouldn't be able to resist getting political.
And we can't have that, or could
We,
we?
but we cannot. We cannot. So, what RSPs look like today?
Okay. First, how much you can contribute. The general rule is that every year you get new RSP room that is equal to 18% of what you earned last year, up to an annual dollar ceiling. And any room you don't use gets carried forward pretty much indefinitely. So let's unpack that.
Start with the annual limit or the annual dollar ceiling. For 2026, it's $33,810. For 2027, it'll be $35,390. Big numbers. But let's be honest. For most people, the maximum amount will be 18% of last year's earnings. You'd have to have a pretty high income before you hit the maximum limit, like about 190,000 without pension adjustments.
So let's explain pension adjustments. There are employer contributions and they lower your limit. So if your employer has a group RRSP, what you contribute to it and what your employer contributes to it take up some of that contribution room. And if your employer has a registered pension plan, an RPP, or a deferred profit sharing plan, DPSP, you get something called a pension adjustment or a PA. That amount gets deducted from your next year's RSP room.
The underlying principle of pension adjustment is really just fairness. I mean, basically, if you get tax assisted pension savings through your job, you don't get to double up by getting the same RRSP room as someone with no workplace pension. But the reduction is literally a dollar for dollar one.
And I have to share a moment of truth here. I only recently learned that this was true. I didn't actually know they were separate until I was doing the math, and I'm like, I wonder why my RSP contribution is so low. And then I dug into it and I'm like, oh, wait a minute. It's because I have an employer pension and it actually is the same thing. So I don't know actually if a lot of people realize this because definitely for me, I only recently really dug into it and looked into it. So don't feel bad if this is the first time you've actually thought about it because I am 100% one of those people. Okay. So the basic rule then, just to reiterate, is if you have no pension contributions through work, you'll have more potential RRSP room. But if you have a pension contribution through work, or they have a matching or a combination of both, you're going to have less additional RRSP room because that will get deducted by your overall number.
Now, here's another really important additional feature. Your annual limit is not necessarily the maximum amount you can contribute in a year. That's just how much new room you get that year. But remember, we said that your unused room carries forward. So let's just say, for round numbers, that your contribution room is $10,000 a year. Last year, you contributed $5,000. That means you carry forward the unused $5,000 to this year. And your contribution room now for this year is going to be 10,000 plus 5,000, so 15,000. And that happens every year that you don't max out your contribution room.
Yeah, if right now you have like an exploding head emoji flash in front of your eyes, know that you are not expected to actually keep track of this number. This is why you really want to go back to one of our earlier episodes around tax filing. When you file your tax, the government keeps track for you. So if any point you're like, hey, I want to contribute to my RRSP this year, I have no idea how much I have in space. You log in and they will have that number for you and they will carry it over for you. So don't feel like you need to keep a notepad in the back pocket to write down your numbers every year. Okay. A few other things about RRSPs. First, you get a tax deduction for the amount of your contribution. We've mentioned that. Now, if you stop and think about that and what that means, it's a tax deduction. It reduces your taxable income. And what's the one thing we know about tax deductions?
They are worth more to people in high income brackets than they are to people in a low income bracket.
Exactly. Let's hold on to that fact. Because what it means, and honestly, I wish someone told this to me when I was in my 20s, is that if you are in a low income year, or if you are just starting out your career and foresee a higher income as your career progresses, you may be much better off not contributing to an RSP, but to save that contribution room for when you make more money. Now, we'll go into the trade offs to consider in a few minutes after we lay out how TFSAs work.
Another really important thing to remember about RRSPs is what happens when you take the money out. Except in very specific circumstances, withdrawals are immediately taxable. And not only that, but you lose that contribution room and you never get it back again.
Now, there are two major exceptions about withdrawals from your RRSPs, and they are important. The first is the Home Buyers Plan, the HBP, which was introduced to make it easier to buy a first home. It allows you to withdraw up to $60,000 from your RRSPs toward a qualifying home without the withdrawal immediately becoming taxable. You generally have to repay the amount you borrow over 15 years. Now, at the last federal spring economic update, and it was then ratified this past June, they extended the HBP, giving first time homebuyers who make a withdrawal between 2026 and 2028 an additional 5-year grace period. So your mandatory 15-year repayment schedule begins in the fifth year, ultimately making it 20 years of time that you would need to repay that instead of starting pretty much immediately that second year.
Second exception for withdrawing money from your RRSP without being taxed on it immediately is the lifelong learning plan, or the LLP. And that lets you withdraw up to $10,000 per calendar year, up to a total of $20,000 for education or training for yourself or for your spouse or common law partner. And these amounts are generally to be repaid over 10 years. We're going to include links to these programs in the episode notes.
Also important to remember, when you make an RRSP withdrawal, except through those very specific programs, your financial institution won't give you the entire withdrawal. They'll withhold tax between 10 and 30% depending on how much you're taking out.
So remember, in times of financial difficulty, think really, 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 really hard about taking money from your RRSPs. It's intended for retirement. It is not a bank account. Okay, that's RRSP basics. Let's take a look at TFSAs.
I'm waiting for the history rabbit hole.
Not as interesting as RRSPs, sorry. TFSAs were launched by the Harper conservative government January 1st, 2009, as a kind of general purpose savings vehicle.
For someone who's trying not to be political, you sure like to call out the respective governments.
Well, that's just historical accuracy. It's my editorial comments that would be political, and I'm not going there. Okay? I guess one of the most interesting things about TFSAs is just how incredibly popular they've become. More people contribute to TFSAs than RRSPs, and that will make a lot of sense when we compare them.
Right, so let's look at the TFSA basics. Like RRSPs, they are registered accounts with tax implications. They have a contribution limit, and you can carry unused room indefinitely. All of the income earned in the registered account accumulates tax-free. But that's where the similarities with RRSPs end. First, the contribution limit. Remember, RRSP contributions are 18% of what you earned last year, minus any pension adjustments up to a set maximum. TFSAs are a lot simpler, and probably why they're more popular. The annual limit is the same for everyone, $7,000 for 2026, and you are eligible as soon as you are 18. Now, TFSAs began in 2009 with an initial annual limit of $5,000 per year. So if you were 18 or older in 2009 and have never contributed to a TFSA, your contribution room would be $109,000. And as always, if you're not sure of your contribution room, you can check it on your My Account page on the CRA or the Canadian Revenue Agency website. Like we said, because they're registered vehicles, the government is really keeping track for you, and there are multiple ways to know or find what those contribution limits are for you.
You're eligible to contribute to a TFSA if you're 18 or older, a Canadian resident for income tax purposes, and you have a valid social insurance number. And unlike RRSPs, you don't need any employment income to earn contribution room.
Also different from RRSPs, you don't get a tax deduction for your TFSA contribution. But, and this is the really important thing, you don't pay any tax when you withdraw from it. No 10 to 30% withheld by your financial institution. You can take any or all of the money out anytime and it's yours.
Another major difference, you never lose the contribution room. If you take out $20,000 this year, you get that $20,000 in contribution back next year. With an RRSP, if you withdraw $20,000 this year, that contribution is generally gone. You can only put back $20,000 from other RRSP contribution room. But pro tip for both these accounts, do not over-contribute. There are really harsh penalties, and they're charged immediately and cumulatively.
Did I tell you that time where I accidentally overcontributed to my RRSPs?
No, what
I,
did you do?
yeah, wow, it's a lot of confessions today. I can't even remember how or why, but I do remember I put in, I want to say like $1,000 in November and realized my mistake. And I took it out immediately. It wasn't even like an hour, but it doesn't matter. So I calculated the penalty, which is 1% per month on the highest excess amount. So again, even if you withdrew it in the same month, next minute, next out, whatever, that 1% still applies and will persist in either account until you either make more room or the excess is withdrawn. Also, if the CRA thinks you deliberately overcontributed, they can tax you at what they call an advantage rate. So you're taking advantage of something at 100%.
So what happened? Did Zero fine you?
Oh, right. So I calculated the penalty, which, obviously 1% of 1,000, not terribly huge. I wrote a check uh, and sent it to the CRA. And I was told to write actually a nice letter and include it with an apology. They obviously never wrote back to me or even acknowledged me, but they never cashed the check either. And sometimes the CRA does that. If they think it was an honest mistake and you explain the situation, they will generally waive the fine.
That's nice. And honestly, I'm not super surprised. They're people. And I've also had a really good experience with CRA when I made a mistake. I've told that story.
Right, right.
Okay, added note. There are also some important differences between RRSPs and TFSAs on retirement and when you die. But we'll get into those when we take on retirement planning, which we're going to do soon, I promise.
Yeah, that's going to be a great episode. This is how you calculate your retirement spending. It's the day you decide to kick the bucket. Okay, sorry, I digress. So, hopefully, now you have a better understanding of what these plans are and how they work. But here's the question, and we get asked this a lot. When should we contribute to what? And if you can't contribute to both, or you can't maximize contributions to both, which one should you prioritize?
It's really interesting. When I was young, back in the dark ages, the advice was always RSPs first. And I will say personally that that was really important advice for us, and we followed it religiously. I mean, I've mentioned before, my husband has always been self employed, and I was self employed for a lot of my career. So, maxing our RRSP contributions every year is absolutely the reason why we're enjoying a comfortable retirement today. But RRSP first is not the general advice today.
Also, as you mentioned, you started in the dark ages. They didn't have TFSAs then, so that kind of makes sense.
Thank you for so kindly pointing that out.
You're welcome.
Okay,
I'm here all day.
so today it's different. The general rule of thumb that a lot of financial planners use is if your taxable income is under roughly $70,000, you should usually prioritize the TFSA and save that contribution room in your RRSP for when you're earning more. And then generally prioritize RRSPs when your taxable income is above roughly $90,000. And in between, it kind of depends on your tax bracket, pension, future earnings, retirement goals. A lot of people split contributions between the two.
But, and there's always a but, there is one major exception to this, and that has to do with the benefits your employer offers. If you're in a lower income bracket and your employer matches RRSP contributions, then you should absolutely think about contributing to your RRSPs first, but only enough to get the full employer match. Like, don't go crazy. So let's look at an example. Let's say you're 32 years old and you're making $75,000 and your employer matches RSP contributions up to 5% of your salary. If you put in that $3,750, so does your employer. And your $3,750 is suddenly $7,000 in your RSP. Pretty hard for any TFSA advantage to beat. Once you've captured every dollar of employer matching, the next dollar may be better in a TFSA, particularly if you're younger, in a lower tax bracket, or you might need the money before retirement.
Now, employer matching is a game changer. And if you don't know if your employer's matching RRSP contributions, find out now. Talk to your HR, your payroll department. This is a really important benefit. It's part of your compensation package. Do not leave money on the table. Okay, here's a strategy that a lot of people use. And I will say it's what my husband and I did. You contribute to your RRSP and you put your tax refund into your TFSA.
Okay, now I have an important warning here, so listen carefully. We mentioned how these are investment accounts. Well, if you make some risky investments and lose money in these accounts, that money and that room is gone. So, generally, you really want to view these accounts as places for tried and true investments. You don't even get to use the capital loss on your tax return like you can for losses in non registered accounts. You lose money in a registered account like RSP or TFSA, you get nothing, perhaps, except pain in the depths of your soul.
That sounds like a painful, real experience.
Yeah, I call it my $50,000 mistake. Now, I applied for every scholarship known to students and accumulated a good amount of money. My brother was huge into investing at the time, and I trusted him with what to me was an enormous amount of money. What I didn't know was that he was heavy into speculative investing. I found myself owning forestry and exploratory mines. Yeah, yes, if you have a visceral reaction to this in a negative sense, you'd be correct. Now, that $50,000, and I checked it today, is now $137.16. One of the stocks that I owned even got delisted from the stock exchange. So when
Dear.
I say speculative, I frickin' mean speculative. And I keep that non performing stock, or what is remaining of it, in my portfolio because it is a reminder to me. Number one, do not trust others because no one will care about your money more than you do. So you must be engaged. And two, risk tolerance is an actual thing, and making sure that you're invested at the right level. Now, I consider myself having a high tolerance to risk, but forestry and exploratory mines? No. Hard pass.
You know what I always say? If you can't sleep at night, you took on too much risk.
Yeah, exactly. And something we definitely need to visit later on. But, my 50K loss notwithstanding, at the end of the day, if you are saving, you should definitely look at doing so inside RSPs and TFSAs. The reason that there are so many rules around them is precisely because they are so useful and helpful for planning your financial future for both the short and the long term.
Okay, 3 key learnings for today.
Right. Number one, RSPs and TFSAs are both registered savings vehicles that offer tax benefits. They can both hold cash, GIC, stocks, bonds, and investment funds. Income grows tax free as long as it is held inside the registered account. But the key difference to remember, RSPs are tax postponed, not tax free. Contributions are tax deductible going in, but withdrawals are tax payable except in specific qualifying circumstances like homes and education. Everything is tax payable coming out. TFSA earnings are tax sheltered, no tax deductions going in, but all withdrawals are tax-free coming out. And RSP withdrawals lose the contribution room permanently, while TFSA withdrawals are tax-free and you get any contribution room back the following year.
Great summary. Number 2, what to do when generally depends on your taxable income today, your expected career income trajectory, whether you think you'll need the money before you retire, and whether your employer offers RRSP contribution matching. Contribution matching almost always tips the scale to RRSPs first to max the employer match.
If you don't know if your employer offers contribution matching, find out now. Like right now. Like, press pause and go today. Don't leave the money on the table. Okay. So finally, prioritize RRSPs if you're in a high tax bracket, your income is likely to be lower in retirement, you want the tax refund now, or you're saving specifically for retirement and aren't likely to need it before. Prioritize TFSAs if you're young and early in your career. Your income is relatively modest. You may need the money before retirement. You expect your income to rise substantially in the future. And you don't want future withdrawals to affect your future government benefits in retirement. And pro tip, use your RRSP-generated tax refund to build up your TFSA. Don't be tempted to spend it.
So that's us for today. What do you think? Have you found this helpful? Do you think you're focusing your savings in the most tax efficient way? If you'd like to share, why not drop us a line or 10 at notjustmoneypodcast@gmail.com.
Good talk. You've been listening to Not Just Money with Doretta and Li. Click on the show's description for links to resources related to today's conversation. Our aim is to share sources that provide objective information that can help you make informed financial decisions. Please rate and review our show. If you'd like to get in touch with us, email us at notjustmoneypodcast@gmail.com. If you'd like to be featured on the show, you can send us your questions and comments by a written email, audio file, or video file. Please include your name and city. This show is produced and edited by Li, with original music by Leo Zhang, cello, and artwork by John Tu. Now for some legalese. Please note that the views expressed by our hosts and guests are theirs alone and should not be viewed as financial advice. This podcast is intended to be entertainment and educational in nature. Please seek additional professional support or information before acting on any podcast information. As always, good talk.